VDY is a favorite of many Canadian investors, and today we're going to find out if they deserve all that fanfare. Fasten your seatbelts, folks. This is going to be a good one. VDY is the Vanguard Canadian High Dividend Yield ETF. This fund is designed to track the performance of the FTSE Canada High Dividend Yield Index, which includes high dividend Canadian stocks, of course. Vanguard themselves often stands out as a great ETF manager. That is, well, it's very attractive to newer investors. Some of the reasons for that include their overall commitment to simplicity and, of course, low costs, while at the same time maintaining, well, a pretty darn good long-term focus. Their philosophy is very much investor first, which ties into the simplicity I mentioned a moment ago. You can also see it with their very diverse selection of well-managed ETFs that make it pretty darn easy for new investors to gain exposure to the market in a passive indexing way. So basically, hands off, no muss, no fuss. Let Vanguard make money for you while you're still learning those ropes. I also want to add, this is 100% not a sponsored video, so any of the good words I have for Vanguard are well earned and not paid for. Join today's conversation and let me know in the comments if you are invested in VDY. Thank you for your participation. If you love this sort of content, be sure to hit that subscribe button for more, and another huge thank you for that click. Let's narrow the talk down a little more specifically to VDY. Vanguard has lots of great ETFs, but this one may just be their most popular, and, well, for a reason or perhaps many. First, if VDY is investing in high-yield Canadian stocks, you might be expecting a half-decent dividend. No worries, they got you covered. They have a solid dividend that is a monthly payer, which folks do tend to love. At the time of recording, that yield was sitting at just over 4%, so that's not too shabby. Next, this is an ETF with some good diversification. They provide exposure to more than a few sectors. However, it does need to be said that because they are seeking higher dividends, they are a lot heavier in the financial and energy sectors. Finally, this is a low-cost ETF in terms of management and, well, taxes as well. They have a low 0.2% management fee, and because they hold Canadian companies with eligible dividends, they do qualify for the Canadian dividend tax credit when you hold them outside of your registered accounts. I should also add that this is a total return ETF. They have good dividends, but you will see steady potential for capital appreciation, creating a well-balanced dividend and growth total return. So this all sounds pretty darn good. But as you know, we are here to look at some of their numbers. And to do that, we need to call on the guy who calculates the area under the curve for fun, the one and only Mr. Math. We will begin as usual with a little surface data. They have a current value at time of recording of $44.94. Their NAV comes in at $45.17. Their net assets under management comes in at $2.49 billion. They have a beta of 0.93, and that means that they are just slightly less volatile than the market average, which would have a beta of 1. Price to earnings ratio, that comes in at 11.29, and their average volume is not too shabby. It's 111,795. Their return on equity, 14.94%, and they have a return on assets of 3.04%. These numbers are good, so let's peel back a little more and take a gander at their fund specifics. As I stated earlier, their management fee does come in at 0.20%, and I do like this. The management expense ratio is pretty darn close at 0.22%. When it comes to holdings, they do hold a total of 59 companies. But let's look at their top 3 holdings. We got the Royal Bank of Canada coming in at 13.87%. We got a TD Bank at 10.76%. So we're definitely seeing those financials. And I'm kind of wondering, with all of the turmoil around TD, if that percentage might come down a wee bit. Hard to say, hard to say. At number 3, we, of course, moving over to energy, we have Canadian Natural Resources, CNQ, coming in at 8.28%. When we look at their diversification, and I said they're heavy, they're top heavy on financials and energy, and you're going to see that. Let's look at those top 3 sectors. We got financials, 55.13%. Holy banana bread, that's That's very heavy. Energy, pretty heavy too, 30.26%. Everybody else is fighting for scraps, but telecommunications comes on the top of that sector with a 5.98%. They are definitely heavy on financials and energy as well. But as we mentioned before, well, that's where a lot of the good dividends live. Let's pull back some more and take a look at their returns. We've already talked about their dividends, so that yield, it does come in at 4.172%. It's a monthly dividend of 17.6 cents per share. Their 5-year average dividend increase is 2.42%. However, with this fund, their dividend changes a lot. So this number is kind of mute. The reason for this is usually because, well, as they shift fund composition, it can change the value of dividends received. Also, sometimes some of these companies in the fund have special distributions, which will mean more dividends. So sometimes you will get a nice little spike in your dividend payment with this one. Looking at their 3-year, their price rose from $40.50 to $44.94. That is a return on investment of 10.80%. Factor in the dividends, you do get a total return of 28.19%. Of course, if you were to reinvest those dividends, you could pump that total return up a wee bit more. On the 1 year, their price rose from $40.78 to $44.94, a return on investment of 10.20%. Factor in the dividends, we get a total return of 15.54%. And let's take a look at this year. Year to date, their price has risen from $42.51 to $44.94. That's a return on investment of 5.72%. Factor in the dividends, we get a total return of 8.14%. That year to date, it's not where I would like it, but as we move into a bull market, I have a feeling they will rebound quite a bit. Okay, we have enough data to pose that question we are all thinking about. What is my final verdict? I do love Vanguard, and this ETF is no exception. With that being said, you do have to factor that into what I'm saying. Hint, hint, that means I'm probably a little bit biased, even though I try not to be. There's that thing called unconscious bias. So always take that into factor when you're listening to somebody rattle on YouTube. In my opinion, this is a great ETF for solid dividends as well as growth potential. They have not hit as well this year as I would like to have seen. But of course, as those rate cuts move in, I do expect to see some a little bit of a better performance in the second half. This is not a bad ETF at all for new investors, or for that matter, any investor looking for a low-cost ETF to complement their portfolio. If you are a full-on ETF investor, then you just want to make sure you're taking into account that we've got a little bit of a lopsided ETF towards financials and energy. So looking at some of your other ETFs, you probably want to make up for that. For the passive income investor, this one is not bad, but a pure income portfolio may pass on it as there are plenty of higher dividends out there. But if you are looking for stability and a little bit of growth, this is definitely your ETF. This is not a bad option for a total return investor, as it will perform as intended consistently. Even this year, where I would love to see some higher numbers, it is still within a very small fraction of their benchmark, or of course that benchmark being the FTSE Canadian High Dividend Yield Index. This is a nice ETF. There's no way around it. I do like it. So that question I posed at the top, are they worth the fanfare? Yeah, they are. If you are interested in VDY, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey by checking out this video on YTSL. Thank you for watching, and I will see you in the next video.